And we are back, everyone. And today we're going to be covering bulletproof risk management. So we've talked a lot about entries, we've talked a lot about strategy, psychology, discipline, but now let's actually get into the exact risk management protocols that I use in my trading. So first and foremost, before we get into that, we must first understand that risk management is the most important factor of trading. Without it, you can have every other element in check and still lose money. So strategy aside, you can literally flip a coin and still be profitable. If you know how to manage risk, you can still stay alive. You can still stay in the game if you have proper risk management. So it is the final layer of protection for your account and for your actual capital. And the other thing you must understand is that trading is a survival game. And we've covered this already, the concept of staying down, base hits, collecting those small wins, and keeping yourself liquid for the unexpected home runs. So we're not going out there trying to hit home runs every day. We're just showing up consistently taking our base hits. And whenever a home run does come, we are alive and we are liquid for the opportunity. So stay alive, stay liquid. A professional trader is slow to risk money, fast to protect it. So with that being understood, let's get into the actual risk parameters. So obviously this is going to be based on your account size, but you have to determine your max risk per position, max risk per day, and your max risk per week. So for me personally, if I'm managing any account, let's just say a $100,000 account, I will use 0.5% per position, and then I'll probably have max risk per day be like 1% per day. So this is just an example, but if I were a beginner trader, this is what I would recommend risking. So max risk per position, 0.5%. So if you have a $100,000 account, you multiply 100,000 by 0.5%, and that's how much you're risking per position. Also, you want to have a max risk per day. 1% a day is a good place to start, and that will cover you for 2 trades if you're risking 0.5% per trade. So you want to have all of this predefined before you go in and start risking money. Otherwise, you're basically going in with no calculation, with no plan whatsoever. And then on top of that, you want to have max risk per week. So let's just say 3% per week. So that allows you to take up to 6 trades per week, 2 trades per day, and you can risk a total of 3% per week. And the reason we want to do this, the reason why we want to have these parameters in place is so that we don't overextend past it. So we don't let emotions and what's happening in the moment determine what we risk. We let our plan and our parameters determine what we risk. And by limiting this exposure, you are automatically putting the probabilities more in your favor. The more exposure you have in the market, the more trades you take, the lower your odds become. And there's this saying at the casino, the number one rule is to keep them playing. The house always wins on a long enough sample size. So the longer people keep playing at the casino, the more money they lose. Even if they end up winning in the beginning, by the end, they're going to lose if they keep playing. And it's the same way in the market. So you want to have as little exposure to the market as possible. That's why I love to just get in and out, couple trades a month, and then I am good. So you want to set these risk parameters up based on your account size, do these calculations, and start to do the math on what your setups would start to look like. And then next we have risk protocols. So we covered risk parameters. Now let's go into risk protocols. So this is basically the if-then scenarios that you want to have for your different risk management. So a trade position is executed, right? You take a trade. There's only 3 outcomes. If it's a losing trade, winning trade, or break-even trade, regardless, you want to have a set protocol for each of these outcomes. So this is what I recommend for beginner traders, and I also still follow this to this day. So if it's a losing trade, cut your position size in half after a loss until you make back that full loss. So if I risk $500, let's say, if I take a loss, I want to cut my risk in half and then risk that $250 to try to get the $500 back, rather than going in with $500 again or trying to risk $1,000 so I can make it back and then some. You want to size down after a loss, and you want to flatline the drawdown. It's called flatlining the equity curve. You scale down, base hits until you get that loss back, and then you can scale back up to your full position size. And then if you take a loss of 250, guess what? Cut it in half again, go down to 125. And this is how you stay in the game through a losing streak. This is how you don't blow your account in 5 trades or 10 trades or whatever it is. Then if it's a winning trade, you also want to have a protocol for that. You don't want to be giving back your wins, and you don't want to let greed take over, and then you end up giving back what you won that day. So my personal protocol is, if my first trade of the day is a winner, I'm permitted to risk only 50% of that first trade's profits. So in other words, I cannot ever give back my entire profit that I made. The most I could lose out of that first trade is 50% of the profit that I made. And that's a good rule of thumb because it still allows you to capitalize on a day where you might be in the flow of things, but it also protects the downside of you giving back your entire winnings from that first trade. So it's still allowing for opportunity, but it's not allowing you to tilt and go over into the greed side of things. And then lastly, if it's a break-even trade, you also want to have a protocol. Me personally, break-even trades don't count towards the max positions, so you can take as many break-evens as you want. But obviously pay attention to emotions too. Sometimes break-evens can be frustrating, especially when they run really far in your favor and then come back at you. So if you notice your mental capital and your psychology starting to tilt, you might want to consider walking away if you take more than like 1 or 2 break-even trades in a row. So the key with this is having a protocol for every single outcome. That way the data is consistent every single time. So risk management isn't just a tool for when you're on a losing streak. Bulletproof risk management means having a set protocol for every potential outcome. And that is how, guys. So make sure you have those parameters in place. And lastly, we're going to cover flatlining drawdown, which is what we were talking about with the losing trade, scaling down to half risk. So you can see here in this example, let's just say your max drawdown on an account was $1,000 and your starting risk was $250. So we're risking $250 per position. So in this example, with fixed risk, so if we're just risking $250 win or loss, we're not scaling down, not scaling up, this is how many trades it would take for you to blow this account. As you can see, not very many. Only 4 trades and the account is gone. Versus if you go on a losing streak with the scaling down method, you can see the first loss of 250, then we scale down to 125, then we scale down to 62.5, then 31.25, and you can see after the same amount of losses where we blew the account here, we are still in the game and we still have over half of the max drawdown left after those 4 losses. So this is how you really stay in the game despite losing streaks. And also with the top and bottom ticking model, the rich off ticks model, it's very easy to turn $62 risk, $31 risk into hundreds of dollars, if not thousands, with the risk to reward ratio that this setup offers. So this is how you scale down. This is how you flatline drawdown. This is bulletproof risk management. So make sure you are implementing this within your trading plan, guys, and make sure you are following these protocols in your trading and not just going out there risking random amounts of money on every trade. And like I said, if you can master this one skill, you are going to be able to stay in the game regardless if you have the best strategy, regardless if your win rate is even that good. You can still stay in the game and make profit if you are a master of risk management. So this is the most crucial skill. It's the most foundational skill to trading, and it's something you want to spend a great amount of time dialing in. So I really hope you enjoyed this lesson. Comment day 29 complete in the comments below. Tomorrow is the last and final day of the bootcamp, guys, but do not worry. I have some exciting things planned for the channel moving forward, and I'm very excited to continue to build on the foundation that we set here in the Rich Off Ticks Bootcamp. So congratulations to everybody who made it this far. I do have a special prize at the finale as well. Special announcement, special giveaway. You know it's giveaway time again. So we are going to be doing another giveaway in the final episode. So stay tuned for that as well.